raise capital in two main forms, debt and equity. Equities are traded through the form of shares and debts are traded through the form of bonds. Not all bonds are alike and they don't always move in the same direction. In fact, there are a wide variety of bonds, so they may seem confusing, but in actuality, only few characteristics distinguish them. It is then quite amusing how these two forms of company financing work. But in this video, we're going to talk about bonds to give you a better understanding of how it works. Bonds are a form of debt. It is simply a loan taken out by a company. Instead of going to a bank, the company gets the money from investors who buy its bonds. It may be confusing at first, but the ones who issues bonds is the borrower, which are usually a corporation, a government, or a foreign government and corporation. In return, these issuers agree to pay interest periodically and pay the principal at a specified time, known as maturity, to the bondholders. These bondholders are commonly known as investors. An investor who buys a treasury bond is lending the government money. An investor who buys a corporate bond is lending the corporation money. An investor who buys foreign bond is lending money to a foreign government or corporation. The role of bonds in a portfolio. Investors have purchased bonds for several reasons: capital preservation, income, diversification, and as a potential hedge against economic weakness or deflation. When the bond market became larger and more diverse in the 1970s and 1980s, bonds began to undergo greater and more frequent price changes, and many investors began to trade bonds, taking advantage of another potential benefit, which is the price or capital appreciation. Today, investors may choose to buy bonds for any or all of these reasons. Capital preservation. Unlike equities, bonds should repay principals at a specified date or maturity. This makes bonds appealing to investors who do not want to risk losing capital and those who must meet a liability at a particular time in the future. Bonds have the added benefit of offering interest at a set rate that is often higher than short-term savings rates. Income. The majority of bonds offer fixed income to the investor. The bond issuer gives the bondholder an interest payment on a fixed schedule, whether quarterly, twice a year, or annually, which can be expended or reinvested in other bonds. Through dividend payments, stocks may also provide revenue, but dividends tend to be smaller than bond coupon payments, and firms make dividend payments at their discretion, while bond issuers are forced to make coupon payments. Capital appreciation. For several factors, bond prices could increase, including a decrease in interest rates and improvement in the issuer's credit standing. Any price gains over the life of the bond are not realized if a bond is held to maturity. Instead, the price of the bond usually returns to its par value as it nears maturity and repayment of the principal. However, investors will realize price appreciation, also known as capital appreciation, on bonds by selling bonds after they have risen in price and before maturity. Capturing the capital appreciation on bonds raises from total return, which is a combination of income and capital appreciation. Over the past 40 years, investing for total return has been one of the most commonly used fund strategies. Diversification. Including bonds in an investment portfolio can help diversify the portfolio. In order to reduce the risk of low or even negative returns on their portfolios, many investors diversify from a wide range of assets, from equities and bonds to commodities and alternative investments. Potential hedge against an economic slowdown or deflation. For many factors, bonds may help protect investors against an economic slowdown. A bond's price depends on how much investors value the income the bond provides. Most bonds pay a fixed income that does not change. As the prices of goods and services increase, an economic phenomenon known as inflation, the guaranteed income of a bond becomes less desirable because less goods and services are bought from that income. Typically, inflation corresponds with rapid economic growth, which raises demand for goods and services. Slower economic growth, on the other hand, typically leads to lower inflation, which makes bond income more appealing. For corporate profits and stock returns, an economic recession affects negatively the attractiveness of bond income as a source of return. If the slowdown becomes bad enough that customers avoid purchasing products and prices tend to collapse in the economy, a dire economic condition known as deflation, then bond income becomes even more appealing because bondholders can purchase more goods and services with the same bond revenue due to their deflated prices. When demand for bond rises, so do bond prices and bondholder returns. Bonds tend to be relatively safe investments. The main reason why risk-averse investors prefer them over other investments. Having regular interest payments and return of invested principal regarded bonds as a more predictable and stable form of investing. As compared to stocks, bonds are apparently less risky. But keep in mind that just like any other investment, they come with certain risks. One of the risks that investors face is known as the default risk. If the issuer defaults, investors will receive less than the promised return. Typically, the higher the probability of default, the higher the premium and the yield to maturity. Issuers' financial stability determines the amount of risk. For deeper understanding, let's make an example. Tuguegarao City wants to build a new baseball stadium by issuing bonds to raise money. Each bond is a loan for 50,000 pesos, payable in 10 years. In order to attract investors, Tuguegarao agrees to pay 6% interest rate, which is referred to as the coupon rate. An investor who will buy the bonds will receive 3,000 pesos each year for 10 years. Once the bond reaches maturity, the investor redeems its bond and Tuguegarao will return his 50,000 pesos principal investment. This situation portrays the good deal between the borrower and the investor. City of Tuguegarao got the money it needed to build the stadium and the investor received regular interest payments and the return of the initial investment. Each bond often carries some risk that the issuer will default or fail to fully repay the debt. Independent credit rating agencies such as Moody's Investor Services and Standard & Poor's that are located in the United States and Fitch Group that is located in London in the United States determine the bond issuer's default risk or credit risk and publish credit ratings that not only help investors in risk assessment but also help in assessing the interest rates on individual bonds. A lower interest rate would be charged by an issuer with a high credit rating than one with a low credit rating. investing needs decisiveness and careful thinking. There are other factors that needs to be considered. It's not all about the yields that matters. Preservation of capital while investing is good. But isn't it better to preserve capital while maximizing the benefits you can get?